The interest in the cryptocurrency market is constantly growing worldwide. More and more people find out about Bitcoin, sometimes without understanding the usefulness or feasibility of this new monetary system. If utility finds its answer in the current financial system with the problems and potential solutions, the DeFi ecosystem comes to answer the problem of feasibility. Stay with me for the next few minutes to talk about crypto lending with its pros and cons, how to access it, and especially why. Hi there, my name is Christina, welcome to my YouTube channel. Here you will find useful information about the crypto space, as my goal is to support education in the digital asset market. Therefore, you'll find exchange reviews and tutorials, explanations regarding the most common crypto concepts and investments, how-to-dos and answers to your questions. So, if you're interested in any of these, please feel free to subscribe to my channel. Today we talk about DeFi and we'll focus on crypto lending, which is a step in stabilizing the crypto ecosystem in the financial market. If you don't know much about DeFi, I invite you to check this video. But what exactly is the crypto lending system? Well, basically it is a simple concept similar to secured loans offered by the traditional financial system. Borrowers can use their digital assets as collateral to obtain a loan in fiat or in stablecoins, while creditors provide the assets needed for the loan at an agreed interest rate. The system also works in reverse. Borrowers can borrow cryptocurrencies based on a guarantee in fiat or stablecoins. The crypto lending system is important because it provides a profitable alternative for those who store digital assets. Until now, there were only two options for holding cryptocurrencies: long-term storage or trading. By being part of the lending system, cryptocurrencies can generate passive income. Since 2018, a number of crypto lending platforms have emerged, and they can generally be classified as centralized and decentralized. Centralized platforms act similarly to banks. They require identity checks, have a custody system that protects the assets, and can form traditional business partnerships with institutions. Some examples are Genesis Capital, Blockify, and Celsius. Decentralized lending platforms, which include projects such as Compound, Maker, and Aave, operate as protocols that can be accessed by anyone without KYC or custody. With the exception of Maker, these platforms have variable interest rates determined by the supply and the demand for an asset on the platform. This can lead to large variation in the interest rates. But how do DeFi loans work? There are a variety of options, but most work the same way. Cryptocurrency holders can deposit assets in a pool, and other users apply for loans and pay interest at the end of the loan period. Loans must be secured with other assets, just like any bank loan. In the case of DeFi, the guarantees are set in other cryptocurrencies, such as Bitcoin or Ethereum. Because crypto prices fluctuate massively, loans are usually over-guaranteed. For example, MakerDAO requires borrowers to guarantee their loans with at least 150% of the loan amount. So, if you want to borrow, let's say 100 DAI, you have to guarantee the loan with a minimum of $150 in Ethereum. At the end of the loan period, the borrower will pay the value of the loan plus the interest that is distributed to the creditors. Pay attention to something. If the value of the guarantee falls below the value of the loan, the guarantee will be immediately liquidated. In such cases, the borrower loses the collateral and the lender loses the interest. So DeFi is a system that takes over existing financial products, such as loans, and transfers them to the blockchain. The idea is to use existing cryptocurrencies to provide financial services using smart contracts. The ecosystem offers the same products as traditional banks, but in a decentralized manner. With a DeFi crypto lending system, anyone can quickly and easily take a loan without having to reveal his identity to a third party. And obviously, there are no requirements to go through the verification procedure of traditional banks. Another advantage is the speed. Because they are based on smart contracts, DeFi loans are granted much faster than bank loans, and creditors can get higher interest rates than those offered by bank deposits. The services are available to anyone with an internet connection, which means that anyone can lend and borrow cryptocurrencies. The crypto lending system increases the utility of cryptocurrencies for all parties, giving borrowers access to capital and creditors passive income. In most jurisdictions, profits from crypto lending are not taxable. In the long run, this situation is likely to change. But there are also a few risks. Take into consideration that many of the decentralized platforms operate without a license and without KYC disclosures, which means their future regulation is unpredictable. Sometimes things can change overnight. The crypto ecosystem uses relatively new technologies such as smart contracts, and it is known for volatility. Therefore, cryptocurrency lenders need to pay attention to the fact that the underlying value of the asset should maintain a good price range. Also, the crypto lending system is based on smart contracts that can be attacked or exploited by hackers. In addition, the platforms are not insured or regulated like the banks, but there are steps towards developing a DeFi insurance system. Okay, so we've seen advantages and disadvantages, but the main question remains: how to make money with crypto lending? Like almost any other investment area, there are several options for making money in the DeFi ecosystem too, depending on how much you know about it. The simplest way is, of course, to borrow the assets you hold. Sites like DeFi Pulse offer tools that show which platforms offer the best interest rates for a particular cryptocurrency. In general, decentralized platforms offer higher interest rates for stablecoins, and centralized platforms offer better rates for the most popular cryptocurrencies. For the more advanced users, the arbitrage system is another way to make profits. For example, you can borrow an asset from one platform to lend it to another where you have a higher interest rate. This activity is riskier as interest rates on decentralized platforms generally fluctuate massively. Those who trade in the margin trading system can also use crypto lending to increase the amount they have available. For example, you can use Ethereum as collateral to borrow a stablecoin, which will later be used to buy more Ethereum. If the price of Ethereum increases, the credit you pay will be in stablecoins and you get some profit. Platforms like DYDX simplify this type of trading because it is built directly into the user interface and it offers leverage up to 5 times. For those with advanced technical knowledge, there is the possibility to act as a liquidator in the DeFi ecosystem. Liquidators run robots that identify loans that have fallen below the mandatory value of the guarantee and liquidate that guarantee to pay the creditor. This activity is very competitive, but significant profits can be made from the liquidation fees. Overall, the crypto lending ecosystem operates much faster than the traditional one and can provide opportunities to earn additional income for crypto enthusiasts. Take into consideration that you have to study the system before approaching it, as the risks are high, but also the profits can be interestingly high. This is all for today. If you have any questions or additional information you want to share, please leave them in the comments section below. And if you enjoyed the video, don't forget to like and share it so many people find out useful information about the crypto space, and also press the subscribe button. I'm Christina, thank you for watching, see you next time!